Level 1, overdraft and a negative balance. Your account dips below zero, maybe by $4, maybe by $400. The exact amount barely matters, because the response mechanism doesn't scale with the size of the problem. It just turns on. An overdraft fee appears within hours, often around $35 at many institutions. Some banks apply it per transaction, so if a few small charges go through while you're already negative, you're stacking fees on top of the shortfall you're trying to fix. The logic is almost precise in how it lands on the wrong moment. If you had money, you wouldn't be overdrawn. Because you don't, you end up with even less. You swipe your debit card at a gas station. Declined. You try again. Declined again. There's a line forming behind you. You're doing mental math you can't finish quickly enough, wondering if yesterday's transfer was enough, while the machine keeps rejecting you and the people behind you are watching. This is what financial pressure actually feels like. Not dramatic, not cinematic, just a card declining while you try to calculate in real time. The bank offers overdraft protection. In practice, that means instead of declining the purchase, they approve it and charge you a fee for sparing you the moment at the register. Some institutions have reduced or removed these charges under pressure. Many haven't. And the burden falls most often on the people least able to absorb it. Billions in overdraft fees are collected in a single year, much of it from a relatively small group of accounts that go negative again and again. The same individuals paying repeatedly in a system that charges for being short on money. At this level, access is limited. Credit cards aren't available. Loans aren't offered. Flexibility, patience, or human outreach isn't part of the experience. What you get is automated. A charge applied by a system that doesn't know your situation. Doesn't know your paycheck arrived late, doesn't know that $47 charge was a subscription you forgot to cancel months ago. It knows one thing: your balance is below zero. Everything else follows. You're not really treated as a customer here. You're treated as a deficit to be corrected. Level 2, low balance. You've brought the account back above zero. Maybe there's $200, sometimes $400, occasionally $600, until rent clears and it drops again. You're no longer overdrawn, but you're still in a narrow margin. The monthly maintenance fee shows up $12 or $15 automatically deducted because your average balance didn't meet the required threshold. That threshold might be $1,500, sometimes $500 depending on the bank. If that amount sat untouched in your account, the fee would vanish. Because it doesn't, the fee stays. You're paying to keep the account that holds your money. The account itself is basic checking or savings. No meaningful interest rates, because the balance is too low to qualify for higher tiers. What you earn annually is close to nothing, while the bank lends out deposits at significantly higher rates depending on the product. That difference, what they pay you versus what they earn, is core to how banking operates. At this level, your balance isn't large enough to compete for. You apply for a credit card. Approval might come, but often in the form of a secured card. One that requires you to deposit your own money as collateral for your credit line. In effect, you're fronting the funds so they can extend you credit against it and charge interest if you carry a balance. It's standard. It's allowed. And it's one of the primary ways credit begins when you're starting at the lower tiers. The service you experience isn't aggressive. It's neutral. The teller is courteous. The app functions. If you call for help, you wait, then speak to someone following a script. Able to resolve routine issues and pass anything else to another layer you won't directly reach. There isn't a relationship here. It's a transaction. You need basic banking functions, and they deliver them. That's the full extent of it. At this level, you're a number, specifically a small one, and the bank's attention to small numbers is almost entirely automated. Level 3, stable income. Something shifts, but not in a dramatic way. You land a steady job, or your existing one starts paying more. Your direct deposit is now around $3,200 a month, arriving every 2 weeks without interruption. The bank notices, not with a call or a message, but through its systems. Your account activity moves from inconsistent and minimal to steady and moderate, and the system reclassifies you accordingly. Credit card offers begin to appear. Not secured cards this time, but standard ones with limits of $2,000, maybe $3,500. The interest rates are still high, somewhere in the low to mid 20% range, because your credit history is still developing, and risk is still being priced in. But the difference is access. The same institution that had nothing for you months ago is now reaching out, placing offers in your mailbox and inside the app. Products that were out of reach are now being presented because your income pattern signals reliability. You apply for a small personal loan, $5,000 for a car repair. It's approved within a couple of days. Not instant, but workable. The interest rate lands around 11%. Not ideal, but manageable. What stands out is that the system responded. You had a need, you applied, and it worked. For the first time, the bank behaves the way people expect it to in theory. The monthly maintenance fees likely disappear. Your direct deposit qualifies you for a waiver. It's a small shift, but it feels significant because you've been paying those fees long enough to notice their absence. Now, your account costs nothing to maintain. You're holding your own money without paying for it. At this point, you're a recognized customer. Not prioritized, but acknowledged. The bank has an interest in keeping you because you generate revenue through card usage, loan interest, and the balance you're building, which they can lend out. You matter in a practical sense. As long as you're active, you're valuable. If you left, you'd be replaced without much friction. Level 4, Growing Savings. There's no sudden breakthrough here, just consistency over time. The savings account reaches $18,000. An investment account grows to $22,000. Credit cards are paid off in full each month, making the high interest rates irrelevant because no balance is carried. Over a few steady years, you've built a profile that looks very different to a bank's risk systems than it did before. Credit limit increases begin happening automatically. You log in and see your limit move from $4,000 to $9,500, then to $14,000. The bank is offering more capacity because your behavior shows you don't rely on it. You pay on time. You don't max out. That combination, low risk and consistent engagement, signals reliability. Loan terms improve. When you finance a car now, the rate offered is closer to 6.8% instead of 11%. Not because of preference, but because your financial profile has changed the risk calculation. The cost of borrowing drops as your track record strengthens. This is where compounding begins to show up within the system itself. Better rates mean lower costs. Lower costs leave more money with you. More retained money builds faster than less. The shift isn't loud. It happens quietly. In approval decisions, in percentage points, in small adjustments that accumulate over time. You're becoming valuable to the institution. Not indispensable, not exceptional, but worth keeping. If you walked into a branch and said you were thinking about moving your accounts elsewhere, there's a good chance someone would try to keep you with slightly better terms, or an incentive to stay. That's a different experience from the quiet indifference of level 2. It isn't personal, but it's the first hint of leverage. Level 5, High Savings and Assets. Your total assets move past $150,000, cash, investments, maybe the early stages of a retirement account growing faster than you expected because you started sooner than most. You're not wealthy by the standards that come later, but you're above what most retail banks see day to day, and the shift shows in how you're treated. The phone experience changes. There's a priority queue for accounts at your level, so wait times drop, and the person who answers tends to be more experienced. They have the authority to waive fees, make exceptions, and approve requests without passing you along. When something breaks, and eventually something always does, it gets fixed faster, and with less friction, because the person handling it can actually resolve it. In some institutions, you're assigned a dedicated banker. Not everywhere, but at better tier branches, a named contact appears. Someone who recognizes your account, reaches out directly, checks in occasionally. It feels like a relationship, and in certain ways it is, though it still operates within a business framework. Their attention is tied to retention. Knowing that doesn't reduce its usefulness. The access is real either way. Pre-approved offers start showing up. Mortgage pre-qualifications, investment options, premium credit cards with meaningful rewards instead of minimal cashback structures. The bank is no longer just reacting to your current balance, it's positioning for your future. You're seen as someone who might grow, and the offers reflect that expectation. You're now a preferred client. Identified, recognized, marked as worth keeping. Level 6, High Net Worth. The threshold varies, but it typically starts somewhere between $500,000 and $1 million in investable assets. At this point, the bank stops being a place you go and starts becoming something that comes to you. Wealth management enters the picture, a bundled service that includes financial planning, investment advice, tax coordination, and estate considerations, all tied into one relationship. The quality varies widely depending on the institution and the advisor. Some are highly skilled. Others are polished salespeople. The distinction matters, and you learn to recognize it because the cost of not recognizing it shows up in your results. The conversations shift. You're no longer being pitched basic products. You're being asked questions about goals, timelines, risk tolerance, family structure. The bank is building a full view of your financial life. Not out of generosity, but because a complete picture allows them to offer more and capture more. The intent is commercial. The experience feels tailored. Both are true at once. Loan approvals move more quickly. The process becomes lighter. Rates improve. When something urgent happens, a wire transfer issue, a fraud lock on an account you need immediately, it's handled in a single interaction. No waiting, no escalation chains. Someone with real authority takes care of it in real time because your account justifies that level of response. At this level, you're not just a customer. You're part of the bank's asset base. Internally, that distinction matters. The procedures, the language, the response protocols, they all change. The gap between this and level 2 isn't just better service. It's a different system operating under the same name. Level 7, Very High Net Worth. Once assets move beyond $5 million, the bank begins offering things that aren't publicly listed. Products that don't appear on the website. Rates that aren't posted anywhere. Access to investment opportunities that require accredited status, higher minimums, or a relationship history most people don't have. The interest rate on your mortgage drops below what someone at level 3 would ever see. Not marginally, materially. Over the life of the loan, the difference adds up to tens of thousands. The bank competes hard for your business because, at your profile, the risk is minimal, and the relationship brings in revenue across multiple products they'd rather have than lose. At this stage, your advisor isn't a generalist. It's often a team. One focuses on investments, another on tax strategy, another on estate and trust structures. They coordinate. They communicate. They meet with you regularly, quarterly, sometimes more, in spaces that don't resemble the standard waiting area. The setting is different, and so is the conversation. You receive what's often described as special treatment. In practice, that means the standard mechanics of retail banking, minimum balances, waiting periods, approval timelines, fee structures, access limits, are applied with flexibility. Not because the rules don't exist, but because the institution has built discretion into how those rules are enforced. And that discretion tends to favor accounts that generate significant value. Level 8, Ultra Wealthy. Private banking is a separate category from wealth management in the same way a charter flight differs from first class. Both reach the destination, but the experience isn't comparable. Here, you don't just have a banker, you have a private banker. That title reflects a specific role inside the institution. This person handles a small number of relationships, sometimes fewer than 20, and their focus is entirely on those clients. They know your family, your long-term plans, what you're building, and what you're trying to protect. More importantly, they have direct access to internal decision makers who can structure solutions beyond anything listed in standard offerings. At this level, terms are often customized. Loan rates are negotiated rather than posted. Investment minimums can be adjusted because the relationship supports it. Processes that might take weeks for a typical customer are completed in days because the request carries weight internally. The system becomes flexible, but in a specific way. Banks don't ignore laws for high-value clients. What they do is use every allowed degree of discretion within those laws to serve relationships they consider important to retain. Fees that technically apply are frequently waived without discussion. Exceptions that usually require multiple approvals are handled quickly, sometimes preemptively. The same system that felt automated and distant at the lowest levels becomes responsive, human, and oriented toward solutions. You're no longer just an account holder. You're a relationship, one that is tracked, managed, and tied to performance metrics inside the institution. Losing you would matter to people whose roles depend on keeping you. That creates a form of leverage that doesn't exist at any earlier stage.